From selling newspapers on the streets to becoming the hidden force that transformed the world of finance, who is this enigma? Stick around, because by the end of this video, you'll uncover the incredible journey of this financial titan and the timeless lessons he left for every investor. Trust me, you don't want to miss this revelation. Ever wondered how legends like Warren Buffett learned to master the money game? Behind every great investor, there's a hidden genius, a mastermind whose ideas sparked a revolution, yet remains an unsung hero to many. We're pulling back the curtain to unveil the man and the secrets that even today's financial giants swear by. Hold on to your hats, because we are about to embark on an exciting journey of money, mystery, and mastery. Stay tuned. This is one story you won't want to miss. Let's see how it all started. Benjamin Graham was born in the hustle and bustle of London in 1894, but his family uprooted to the Big Apple when he was only a year old. His childhood wasn't easy by any means. His parents changed their surname from Grossbaum to Graham out of courage in the face of anti-Semitic and anti-German attitudes. Benjamin's dad was a prosperous importer, but he died of cancer when he was 9, leaving the family in financial limbo. Graham's unyielding tenacity and pure resolve positioned him on a unique route to greatness, much like the successful investor Peter Lynch, whose father also endured an early death. Graham's love of learning was boundless, even at a young age. He was academically successful, achieving independent mastery of several languages. A coveted scholarship sent him to New York City's Columbia University when he was only 20. In this environment, his curiosity for the fascinating field of finance would explode. Graham excelled in his studies at Columbia under the guidance of some of the most prominent economists of the day. He completed his bachelor's and master's degrees in English and mathematics in under 2.5 years. His outstanding intelligence attracted the attention of numerous employers, and he was eventually offered positions teaching English, mathematics, and philosophy. But the allure of Wall Street was too much to resist. Benjamin Graham's exciting career began in 1914 when he took a job as a clerk at the prestigious brokerage company Neuberger, Henderson, and Amp Loeb. By the time he turned 25, his analytical prowess and work ethic had propelled him to the position of partner at the company. Graham made a fortune of $500,000 during this time, but nearly lost it all in the 1929 stock market crash. Despite this devastating setback, he persisted. This setback didn't faze him, and he continued to use his superior investment knowledge to make up for his losses, and then some. In the 1920s, when Graham was making his way on Wall Street, the economy was booming and stock market speculation was at fever pitch. In the middle of all this chaos, he developed the now iconic concept of value investing. Benjamin Graham's amazing success and sparkling portfolio are both attributable to his employment of this powerful investment method. Benjamin Graham and Jerome Newman started their own investing business, Graham-Newman Corporation, in 1926. The founders of what would become one of the world's most successful investment organizations could not have predicted their success. Graham-Newman Corporation was successful despite the economic downturn. Whence came their success? Benjamin Graham's hidden weapon was his financial theory, which he named value investing. Instead of following the newest trends, this method looked for cheap companies with solid fundamentals. Graham-Newman Corporation's astounding 17% annualized return throughout its 20-year history may be attributed in large part to the company's steadfast adherence to this principle. The S&P 500 index, by comparison, returned only 12.2% during the same time frame. Graham's investment in Geico is often cited as an illustration of the success that may be achieved through a value-oriented strategy. He found out in 1948 that despite the insurance firm's book value of $56 per share, it was only trading at $27. Graham, seeing an opportunity, bought half of the business for $712,000. A teenage Warren Buffett soon followed suit, drawn to the company because his role model, Graham, was chairman of the board. This information sparked an unprecedented level of enthusiasm in Buffett for Geico shares. The prospect of this investment thrilled him more than any other he had ever considered. The value of Geico surged over the subsequent decades, providing enormous returns to Graham-Newman Corporation and Buffett's Berkshire Hathaway. That original investment was worth an astounding $400 million by the time Graham-Newman Corporation shut down in 1955. This return of 56.6% demonstrates the effectiveness of value investing. How would you sum up Benjamin Graham's investing philosophy in a few key points? Learn from Warren Buffett's mentor, Benjamin Graham, whose financial methods have stood the test of time. Let's take a good look at these principles. Number 1. Why value investing is so important. Benjamin Graham created a timelessly effective investment method called value investing. How, though, does it function? The essence of value investing is buying stocks at a discount in the hopes that the market will recognize their true value and thereby increase the investor's wealth. There is another name for these businesses: net stocks. Does this strategy live up to the hype? Indeed, and Warren Buffett is a walking example of it. Buffett is a legendary investor and a student of Benjamin Graham's. In 1984, he published a seminal study titled The Super Investors of Graham and Doddsville. Buffett's masterwork chronicles the financial success of various followers of Graham's value investing principles. These super investors often achieved extraordinary returns, proving the efficacy of value investment. Berkshire Hathaway, Buffett's own investment behemoth, has generated yearly returns of over 20% since 1965, thanks in large part to Buffett's steadfast adherence to the tenets of value investing. While the availability of net stocks has decreased as markets have gotten more efficient, the fundamental principles have not changed. Number 2, consider the safety net. In value investment, the margin of safety is crucial. Graham argued that the only stocks worth buying are those that are currently undervalued. If the firm's performance or the market's valuation of the company drops, this discount will act as a safety net and prevent further financial damage. An investor's financial security net is the margin of safety, which is the difference between the stock's market price and its intrinsic value. Graham advocated a meticulous examination of a company's financial accounts, paying special attention to such metrics as profit, dividends, and assets in order to determine the margin of safety. He sought to reduce the possibility of suffering a total loss of investment money while increasing the likelihood of realizing a profit. Number 3, dig into some basic analysis. Benjamin Graham understood that successful investing required careful fundamental examination. Investigating a company's finances, market share, and growth prospects thoroughly will reveal its actual inherent worth. Undervalued possibilities with the potential for big profits can be found by comparing this value to the stock's current market price. What then should we do? Price earnings, PE, and price book, PB ratios are two examples of financial ratios to look at first. These indicators reveal information about a company's financial health, growth potential, and profitability. But that's only the beginning. To really get to the bottom of things, you need to examine things like balance sheets, income statements, and cash flow statements. Check out businesses that have these qualities: profitability that has been shown repeatedly, stable increases in profit margins, payout plans designed to calm investors' nerves in the face of fluctuating markets. Number 4, accept the long haul. Benjamin Graham advocated thinking in the long term when weighing investment opportunities. He understood that temporary shifts in the market might result in irrational pricing, providing excellent opportunities for value investors willing to hang on to their holdings for the long haul. Patient and disciplined play will pay off in the long run. Avoid getting caught up in the market's roller coaster of emotions, and instead concentrate on a company's basic fundamentals. Keep in mind that it might be quite some time before the market finally realizes a stock's full value, but once it does, the payoff could be substantial. Number 5. Invest in a wide variety of things. Benjamin Graham was an expert at reducing losses while increasing profits over the long run. He uses diversification as a secret weapon. Financial success is yours for the taking if you diversify your holdings over a wide variety of assets. Because the stock market is so unpredictable, it's a waste of time to try to guess which stocks will skyrocket and which will fall. Diversification, however, has come to the rescue. By spreading your bets out, you may enjoy the success while shrugging off the failures that won't derail your investment strategy. Number 6. The contrarian investing theme. Never follow the herd. Try something different for a change. Graham was an outspoken supporter of the contrarian investment approach, which goes against conventional wisdom in order to find bargains. But why was this strategy so important to him? And what are the benefits of taking a contrarian stance while investing? When investors get enamored with a certain stock or industry, prices can surge. However, contrarian investors look for firms that the market has overlooked or undervalued, and these stocks frequently produce better long-term returns. To find investing opportunities, contrarian investors often go against conventional wisdom. This allows for more competitive pricing and higher profit margins. Number 7. How to invest safely and securely. Invest in a safe way. Defensive investment is a prime example of effective wealth management, which puts steady growth and capital preservation ahead of high returns. You guessed it, Benjamin Graham came up with this brilliant plan. The goal of this strategy is to acquire shares in leading dividend-paying businesses with global presences. Is there a model defensive investment that we may look at? Johnson & Johnson is the global leader in healthcare and your best bet. J&J has a long and illustrious track record of consistent stability, financial strength, and dividend payments. Take a look at these salient features of J&J that make it a safe investment, dominating the healthcare industry across several sectors, including pharmaceuticals, medical equipment, and consumer goods. Consistent increases in both income and profits. Strong financial standing with very little debt. A real dividend aristocrat with a track record of dividend increases spanning more than half a century. These are what made J&J an amazing investment over time. Number 8. How to invest like a risk taker. Benjamin Graham's advocacy of enterprise investing appeals to risk takers who see extraordinary rewards in the cards. This tactic calls for initiative and an in-depth understanding of market dynamics. Investments made with an entrepreneurial spirit typically carry a higher degree of risk and benefit from proactive, long-term management. Investors who are willing to take risks and profit from market inefficiencies and mispriced securities are like treasure hunters in search of cheap assets. Coca-Cola is the epitome of business ingenuity. The storied beverage producer has consistently returned favorable profits to its shareholders over many years. Let's take a look at what makes Coca-Cola such a bold investment. A famous name all around the world that has built a solid reputation and devoted following. Stable revenue and profit expansion thanks to new products and smart mergers and acquisitions. It is a safer bet than investing in rapid growth firms due to decreased stock price volatility. Consistent dividend payments over a long period of time are a plus for income investors. Investors see this as a long-term growth opportunity because they believe the firm can successfully respond to shifting customer tastes while maintaining its dominant market position. Not all of Benjamin Graham's investing advice will resonate with your own philosophy or long-term objectives. It's important to take advantage of these invaluable insights along the way, but you should also feel free to try out your own investing strategies and learn from other highly regarded financial experts. Now, let's examine the effect that Benjamin Graham's ideas on investing have had on the world today. Value investing and Warren Buffett's approach. We can see the legendary impact of Benjamin Graham's financial philosophies today through the success of people like Warren Buffett. Benjamin Graham was Warren Buffett's mentor, and the timelessly effective value investing techniques he advocated are directly responsible for Buffett's meteoric rise to the top of Berkshire Hathaway. Buffett, ever the dedicated student, adopted these concepts and used them to turn around a failing textile firm and turn it into a powerful conglomerate. In 1956, Buffett put out $100 to establish a foothold in Berkshire Hathaway, a struggling textile business. He saw the unrealized potential in the company's cheap assets and rushed to buy stock. By 1965, Buffett had taken the leadership of Berkshire Hathaway and was using Graham's principles to push the business into the insurance and investment sectors, where it would eventually soar to a spectacular $600 billion conglomerate. Initially, Buffett's technique was similar to Graham's cigar butt investment strategy, in which investors try to find firms with one last puff of value. But over time, Buffett shifted his focus to favor firms with wide competitive advantages, sometimes known as economic moats. One question you might ask is, do value investments still make sense in today's market? Some may question the relevance of value investing in this day of lightning-fast trading and technology-driven growth stocks. However, Buffett's continued success demonstrates the efficacy of value investment strategies. Value investing is still a great option for patient, long-term investors, even though it is more difficult to find cheap jewels in the present market. By focusing on a company's core competencies and competitive advantages, value investors can still find ways to make money. The famous investor and author of the best-selling book Margin of Safety, Seth Klarman, is an ardent follower of Benjamin Graham. Graham taught Klarman the importance of maintaining a comfortable margin of safety in every investment. Also, Joel Greenblatt, a successful investor and author, is another person who has greatly benefited from Graham's lessons. In his book, The Little Book That Beats the Market, Greenblatt explains his magic formula, a quantitative investment method that combines value and quality investing. Conclusion: the legacy of Benjamin Graham is a beacon of insight in the field of finance. His beliefs, which are based on careful research and strict self-control, have impacted many investors over the years. The success of those who follow his advice is evidence of the everlasting relevance of his teachings. Let us take to heart the wisdom Graham imparted as we celebrate his remarkable life. Thanks for your time. Don't move away without sharing this video and subscribing to this channel.